Listen up, because the next move the Federal Reserve makes is going to blindside a lot of people who think they've got this figured out. Everyone's waiting for the first cut, like it's some guaranteed free money coupon. But the way this week just played out, it's a warning flare. And if you miss what they're really signaling, you're going to misread stocks, bonds, housing, and even your own job security. I'm running a campaign to eliminate copycat channels, so if you value what I do here, support the mission by subscribing and dropping our John AG in the comments. In this video, I'm going to walk you through the key moments from the press conference, but I'm not doing it like a boring recap. I want you to feel the temperature in the room. I want you to hear how the answers were shaped, where the guardrails were, and where the real message leaked out by accident. Because there were a few lines in there that sounded harmless, until you connect them to what's happening behind the scenes. And quick heads up, the description has bonus links, including a premium WhatsApp channel link and a channel membership join link, so if you want the extra updates and the tighter community, that's where it is. All right, let's start where the Fed always starts, the "we're fine" statement. The chair opened with the standard dual mandate talk, maximum employment, stable prices, benefits for regular Americans. Then he basically said the economy came into this year on solid footing, that growth looked firm, the labor market wasn't falling apart, and inflation was still elevated. That combination is the entire reason we didn't get a cut. And just to ground this in plain English, high rates are the Fed's brake pedal. When they cut, they're easing off that brake. When they hold, they're saying, we still want pressure on the system. That pressure shows up everywhere. Mortgages, credit cards, business loans, even the way companies decide whether to hire or fire. He also reminded everyone that they'd already done a string of cuts before this meeting. That matters because the Fed isn't trying to look indecisive. They cut, they pause, they watch. That's a classic rhythm. And when they pause, they want the economy to prove it can cool without them chasing it around. But here's the part. Most people speed past. They said they already cut earlier, and now they believe the current stance is appropriate. That word, appropriate, is a locked door. It means we did what we needed to do, now we're watching. And when the Fed is watching, they're not in a hurry to do you any favors. Based on recently published numbers, the economy has been doing that annoying thing where it refuses to neatly slow down on command. Consumer spending hasn't collapsed. Services demand is still sticky. And when an economy won't cool, inflation has a nasty habit of hanging around like smoke in a room you can't air out. And don't get fooled by the idea that inflation is down means the fight is over. The Fed isn't targeting your grocery bill. They're targeting an overall trend, and they're obsessed with whether inflation is broad-based or concentrated. If only one or two categories are improving while the rest keep creeping, the Fed sees that as fragile progress. One of the reasons this is complicated is because the most painful costs for households don't always fall first. Rent resets slowly, insurance reprices on its own schedule, medical costs have their own world. And services inflation, things like childcare, repairs, dining out, tends to be tied to wages and labor availability. That's why the labor market keeps showing up in every answer. So the first big question comes up, the one that gets asked every single time, just with a different haircut. Okay, cool. When's the next cut? And the chair's response was basically a masterclass in giving you a sandwich with no meat. He didn't say, soon. He didn't say, next meeting. He didn't even say, we're leaning that way. He said they're well positioned and they'll go meeting by meeting. And he pointed to incoming data. He talked about growth looking stronger than before. And he repeated that inflation is still elevated. Here's why that matters. When the Fed says meeting by meeting, it's not neutral. It's a stall. It's the Fed buying time. It's the Fed telling you, stop trying to front run us. And let me translate the subtext. If growth is picking up again, the Fed doesn't want to fuel that. If the labor market is stabilizing, the Fed doesn't feel an emergency. And if inflation is still elevated, the Fed doesn't want to declare victory and get embarrassed 6 months later. There's a reason they keep repeating the phrase data dependent. It's not because they love spreadsheets. It's because the moment they commit to a timeline, markets will price it in hard. Financial conditions will loosen, and then inflation progress can stall. They've seen that movie before. In fact, if you look back at other cycles, a lot of market pain comes from one thing: people assuming the Fed is about to pivot, and then the Fed stays put longer than expected. That gap between expectation and reality is where volatility is born. And I want you to remember this. The Fed doesn't move when the crowd is comfortable. The Fed moves when the risk of doing nothing becomes bigger than the risk of acting. That's why the most important words are the ones that signal risk. Now, I'm going to say something that's going to annoy both extremes. The Fed is evil crowd, and the Fed is omniscient crowd. Ready? The Fed doesn't actually know the exact path here. They have models. They have data. They have staff. But the economy is messy, and their job is basically steering a cruise ship through fog using last week's weather report. And the chair's language showed that uncertainty. Even though he tried to hide it behind calm words, he acknowledged the growth outlook looked better. He suggested labor conditions had stabilized. That's the key word again. Stabilized, not booming, not cracking, stabilized. And when things stabilize, the Fed's urgency disappears. Now, here's the cliffhanger. Stabilization can be the calm before a very different storm, because a stable unemployment rate can mask softening underneath. Hours worked falling, part-time work rising, people taking second jobs, wage growth cooling without anyone celebrating it. And if you're only staring at one headline number, you're late. Also, there's a structural angle people don't talk about enough. The labor market can look fine even while households feel worse because more people are working, but spending power is thinner. If wages rise slower than the cost of living, you don't feel stable, you feel trapped. The Fed can call that balanced, and you can call that barely hanging on. Both are describing the same reality from different floors of the building. Next question. The reporter basically asks, you cut before because you were more worried about the labor market than inflation. Is that still the case? This is where you expect a clean answer. Either yes, labor risk is still bigger, or no, inflation risk is bigger. Instead, he did something that tells you exactly how cautious they are. He said risks to both sides have diminished. Upside inflation risk, a little less. Downside employment risk, a little less. Then he refused to rank them. Now, that sounds harmless, but it's actually revealing. Because if the Fed truly believed inflation was handled, they'd be much more comfortable easing. And if they truly believed the labor market was fragile, they'd be cutting to get ahead of it. But when they refuse to pick a side, it usually means they're afraid of being wrong in public. And speaking of being wrong, let me challenge something people assume here. A lot of folks hear inflation is coming down, and they immediately think, okay, we're done. But inflation isn't one thing. It's a bunch of categories fighting each other. Goods can cool while services stay hot. Energy can dip and then rip. Shelter can lag. Wages can stay firm even if hiring slows. So even if the inflation headline looks better, the underlying stuff can still make the Fed nervous. And here's the skeptical alternative perspective. It's possible the Fed is underestimating how quickly the labor market can turn once credit stays tight long enough. Companies don't lay people off the second rates rise. They squeeze budgets, they freeze hiring, they cut bonuses, they reduce hours. Then, after a few quarters, the job cuts arrive. So the Fed saying risks are diminished might be true for the moment, but the lag can make that confidence dangerous. From recent market updates, you can see this in how traders react to every inflation print like it's a season finale. One month looks good and everyone screams cuts. The next month is sticky and everyone panics. That's not stability, that's anxiety with a trading app. Now another question comes in. This one is more practical. What exactly would you need to see to resume cutting? Is it labor deterioration, or is it enough for inflation to soften? And the chair finally gives you something usable. He says a weakening labor market would argue for easing, and inflation softening could also do it. But, and this is the giant but, he says if the labor market weakens while inflation gets worse, that's a very difficult situation. That line right there is the hinge, because that's the scenario everyone wants to pretend can't happen. Stagflation light. Not the full horror movie version, but the version where growth slows, people feel squeezed, and prices don't fall fast enough to give relief. That's the scenario where the Fed gets trapped, and policy becomes a pick-your-poison decision. And if you think that can't happen, go pull up what happened in the 70s. You had energy shocks, supply constraints, wage pressures, and policymakers who kept thinking inflation was transitory in the sense that it would politely leave the party. It didn't. It demanded the aux cord. Now, I'm not saying we're repeating history exactly. Different economy, different demographics, different tech, different global trade patterns. But the rhyme is what matters. The rhyme is inflation can fall and then reaccelerate, especially if financial conditions loosen too early. Here's another layer that's new in this era: productivity. If productivity is strong, the economy can grow without as much inflation pressure. If productivity weakens, wage growth can translate into higher prices faster. That's why you'll hear policymakers talk about supply-side improvements and potential output, even though it sounds like academic jargon. They're hunting for a world where growth doesn't reignite inflation. And watch this, because it's the part no one wants to admit. Markets themselves can sabotage the Fed. If investors believe cuts are coming and they bid up stocks, loosen credit, and drop mortgage rates, that can re-stimulate demand, which then keeps inflation sticky, which then delays cuts. That feedback loop is real. You can literally see it when risk assets rally on good news that inflation is falling. The rally makes households and companies feel richer. Feeling richer supports spending. Spending supports inflation. Then the Fed has to hold tighter longer. It's a weird loop, but it's the world we're in. So you can see why the chair kept saying, in basically polite language, let the data guide us. That's code for stop trying to pressure us into a calendar. Now let me add one more thing about the Fed's communication style. Notice how they avoid the word promise. They avoid the word commit. They avoid anything that lets a headline writer lock them into a corner. That's because the Fed learned a brutal lesson over the last couple decades. The market trades the Fed's words, not just its actions. A single adjective can change trillions of dollars of pricing. That's why the chair sounds careful to the point of boredom. Boredom is a feature, not a bug. And here's the sneaky part about no-cut decisions. The Fed can hold steady and still tighten. How? If they keep rates flat while inflation falls, the real interest rate rises. That means policy becomes more restrictive over time without them touching the dial. So even a pause can be pressure. That's why the chair kept pointing at the same trio of ideas: growth, jobs, prices. Because if growth stays firm and jobs stay firm, there's no rush. And if prices are still above target, there's no victory lap. Simple. Also, watch what they don't talk about directly: the neutral rate. That's the mythical level where policy is neither stimulating nor restricting. If that neutral level is higher than people think, because of deficits, deglobalization, supply constraints, or just a more investment-hungry economy, then normal rates might not look like the last decade. That would shock a lot of investors who built their whole worldview on ultra-cheap money. And while the chair was answering questions, you could almost feel the market repricing in real time. You get that split-second rally on a friendly phrase, then a quick pullback on one cautious sentence. That whiplash is telling you something. Confidence is brittle. People want reassurance, but they're not getting it. So if you're sitting there thinking, I'll just wait until the Fed saves me, I need you to understand the uncomfortable possibility. The Fed might not save you quickly. They might simply wait for the economy to prove it's cooling, even if that takes longer than anyone wants. And one more thing, when cuts finally arrive, they may come in smaller steps than the crowd expects. The Fed can cut and still sound hawkish, basically saying, we're easing a little, but don't get carried away. That kind of cut can lift headlines, but not fix your monthly payments overnight. The real relief usually shows up later, after lenders and employers believe the trend is real. Timing matters more than blind hope. Now at this point, most recaps would wrap it up and say, okay, no cut, maybe later. But the press conference took a turn into something deeper. A reporter asked about the government's fiscal trajectory, basically the deficit and debt situation, and pointed to how other countries' bond markets have had episodes of stress tied to fiscal worries. And the chair's answer was one of the most quietly blunt moments of the whole event. He said the budget deficit is on an unsustainable path. He separated level from path. Translation: the pile is big, but the direction is the problem. And then he said something that should make every single person listening sit up. We're running a very large deficit at essentially full employment. That is not normal. That's like flooring the gas pedal while the engine is already revving. In a typical cycle, deficits blow out when unemployment spikes and tax revenue falls. Doing it while the labor market is tight means you're using fiscal fuel in good times. So what happens when bad times show up? Here's where the comparison to other countries matters. When a government carries large debt, it can still be fine as long as investors trust the system and growth supports the tax base. But if investors start doubting the path, if they start thinking the borrowing never stops, then yields can move up and the interest expense grows like a weed. And interest expense is the silent budget killer. You don't see it in your daily life, but it eats policy space. When more tax dollars go to interest, there's less room for everything else. That's when leaders start making choices they don't want to make. And here's the cliffhanger. If investors start demanding higher yields to fund that kind of borrowing, it can keep long-term rates elevated, even if the Fed wants to cut short-term rates. That's the part too many people miss. The Fed controls a short rate, the market controls a lot of the long end. And when deficits are huge and bond supply is heavy, the long end can become its own monster. According to the latest publicly available issuance calendars, borrowing needs don't just gently drift lower, they come in waves. And waves can push yields around in ways that confuse people who think the Fed is the only driver. And so when the chair says, the sooner we work on it, the better, he's not giving you a fun trivia fact. He's telling you the quiet risk: fiscal stress can become a rate story, and a rate story can become a market story, and a market story can become a household story. Now, the chair tried to tamp down any panic by saying he's not tying it to a near-term event, but he also used language like endgame and difficult. He's basically saying, if we never address this, the math eventually forces pain. That could mean higher taxes, lower spending, higher inflation, financial repression, or some combination that nobody wants to campaign on. Let me also push back on a common misunderstanding about the Japan comparison. Japan's story wasn't just debt. It was demographics, long periods of low growth, and a central bank that experimented with policies that kept yields pinned down for a long time. The US has different demographics and different growth dynamics, but we do share one risk. If the market decides the long-term fiscal story is getting worse, yields can become volatile, and volatility itself becomes the problem. And if you're thinking, okay, John, that sounds dramatic, let me bring it back to your life. Elevated rates don't just hit Wall Street. They hit car payments, credit cards, small business loans, and the ability for companies to roll debt. When refinancing gets expensive, hiring slows. When hiring slows, bargaining power shifts. And when bargaining power shifts, wages stagnate while costs remain annoying. That's how people get squeezed without a single headline screaming, "Crisis." Now we get to the moment that hit hardest emotionally. A reporter asks, essentially, what do you say to Americans who feel like they can't make ends meet because the cost of living keeps rising? And this is where you learn whether someone understands the psychological side of inflation. Because here's the truth. Even if inflation slows, prices don't magically go backward. If eggs were $2 and now they're $4, and inflation drops from 8% to 3%, that just means eggs might go from 4 to 4.12, not back to 2. People feel that. They remember the old price. It's like a scar. The chair's answer acknowledged something important. Spending is uneven. Higher income households with assets, real estate, stocks, have had their net worth climb, and that supports spending. Meanwhile, lower income consumers have been trading down, buying less, changing habits, stretching dollars. That's real. And if you've been to a grocery store lately, you don't need an economist to tell you people are comparing unit prices like it's a sport. But here's where I'm going to add my own perspective. Even when inflation cools on paper, there's a lag before people feel it. Part of it is wage catch-up. Part of it is rent resets. Part of it is that certain bills, insurance, utilities, repairs, don't care about the inflation headline. They move when they want. And there's another layer, psychological inflation. When people lose trust that prices will stay stable, they behave differently. They stock up. They demand raises. Businesses preemptively raise prices. It becomes a mindset, not a statistic. Here's the uncomfortable truth. A lot of families don't need inflation to be high to be miserable. They just need prices to be higher than their paycheck. And because prices rose fast for years, and that gap widened. So even if inflation is moderating now, the damage is already in the baseline. So when the Fed says inflation is somewhat elevated, that's them talking in policy language. When households say, "I'm drowning," that's lived experience. Both can be true at the same time. Now, let me connect all these beats, because this is where the recap turns into a plan. We had solid growth, stable labor, inflation still elevated. That leads to no cut. Then we had no timeline promised. That leads to uncertainty. Then we had cuts would require either clear inflation progress or labor weakness. That leads to data dependence. Then we had a blunt warning about fiscal trajectory. That leads to long-term rate risk. Then we had the cost of living reality. That leads to political pressure and social strain. Here's the cliffhanger. All of that points to one uncomfortable conclusion. Rates can stay higher for longer, even if everyone hates it. And that doesn't mean they never cut. It means the path is not the smooth escalator people are pricing in when they get overly confident. So what should you watch next? I'm going to give you a few things, but I want you to listen the way the Fed listens, not the way social media listens. First, watch labor market cooling that shows up before unemployment spikes. That means payroll growth slowing, job openings falling, quits rate declining, temp work dropping, and hours worked softening. The unemployment rate is a lagging indicator. By the time it jumps, the story has already been written. Second, watch inflation composition, not just the headline. If goods disinflation is doing all the work but services inflation stays sticky, the Fed will stay cautious. And services are tied to wages. That's why they care so much about labor stability. Third, watch financial conditions. If markets rally hard and credit spreads tighten, that can delay cuts. It sounds backwards, but it's true. A booming market can make the Fed's job harder because it recreates demand. Fourth, watch the bond market's long end. If long-term yields remain elevated because of supply, deficits, or term premium shifts, that can keep mortgage rates and corporate borrowing costs high, even if the Fed eventually nudges the short rate down. So you could get cuts without relief. Let that sink in. And fifth, watch expectations. When the Fed thinks expectations are anchored, they can be patient. When they think expectations are slipping, they get aggressive. The entire inflation fight is partly about psychology. Now, I know some of you are thinking, okay, so what do we do? I'm not going to pretend there's one magic trade, but I can tell you how I think about it. I think about scenarios. What happens if inflation keeps cooling slowly and labor stays stable? That's the soft landing narrative, and cuts might come later, but probably not in a rush. What happens if labor cracks while inflation is still sticky? That's the ugly scenario. What happens if inflation reaccelerates because energy spikes or supply chains tighten again? That's a different ugly scenario. And what happens if growth stays hot and inflation refuses to go to target? That's the higher for longer. Here's a counterpoint that matters. Some people assume the Fed is eager to cut because politics and pain. But the Fed also knows that cutting too early and reigniting inflation would destroy credibility. And once credibility is damaged, the cost to fix it later is bigger. That's why they'd rather be late than wrong in the easy direction. So don't take the calm tone as a promise. Calm tone is a tactic. The message is in the constraints they repeat. Now let me make this video actually useful for your life, not just your brain. If you're trying to build wealth right now, the biggest edge you can have is cash flow discipline and a plan that doesn't assume rates will bail you out. If you've been paying down high interest debt, keep going. If you've been building skills that increase your income, keep going. And if you're successful, share your success story in the comments so others can stay motivated. I mean that. People need to hear wins, not just doom. Also, if you want the deeper dive content, we do members-only videos produced by a separate team that goes heavier on the research and the numbers. And those are only for premium members. That's where we get into the details that would slow down a public video like this. Now, back to the press conference, because there's one more subtle thing people missed. The chair kept using language that implies the Fed sees itself as in a good place. That can sound like confidence, but it can also be a sign that they're comfortable holding steady for a while. And that's why I want you to watch the next meeting differently. Don't watch for the cut, watch for the phrasing shift. Do they start saying inflation is moderating more decisively? Do they start highlighting downside risks to employment more? Do they acknowledge tighter financial conditions? Those language shifts are the breadcrumbs. Because here's the truth. The Fed rarely surprises without telegraphing first. The market surprises itself because it hears what it wants. Now, I promised high retention, so let me give you the so what in a way that sticks. If rates don't come down as fast as people expect, then expensive debt stays expensive. That means weaker companies struggle. That means layoffs can show up in pockets, not everywhere at once. That means the stock market can look fine until suddenly it doesn't. That means real estate stays frozen in certain segments because sellers won't drop and buyers can't afford. And the kicker is this: a slow grind hurts morale more than a quick crash. A crash is obvious. A grind is psychological. People slowly adjust their lifestyle downward without ever having a single day where they say, "It's official, I'm poor." That's the environment we need to be prepared for. But I'm not here to scare you. I'm here to sharpen you. So let's talk about what would actually force the Fed's hand. If unemployment jumps fast, that's the fastest trigger. If inflation collapses quickly because demand drops, that's another trigger. If credit markets freeze, that's a trigger. If something breaks internationally and spills into US funding markets, that can become a trigger. And yes, fiscal stress can become a trigger if it starts messing with the bond market in a disorderly way. But most of the time, it's not one dramatic event. It's a sequence. A few weak data prints, a few softer earnings, a few more layoffs, a few more late payments, then suddenly everyone realizes the trend changed. So here's a question for you. Do you think the first cut comes because inflation improves or because the labor market deteriorates? Drop your answer in the comments, because the reason matters as much as the cut itself. And let me ask you a second one. If rates stay high longer, what's the one part of your financial life you're tightening up first? Subscriptions, eating out, travel, or debt payments? I want to see what people are actually doing in real life. Now, I want to circle back to that fiscal comment because it's the sleeper issue. A lot of people treat deficits like background noise, but deficits become loud when they collide with inflation and rates. When the government runs big deficits, it issues a lot of bonds. More supply means the market needs more buyers. If buyers demand higher yields, the cost of capital rises. That can crowd out private investment. It can tighten conditions without the Fed moving a finger. This is why you can't just watch the Fed funds rate. You have to watch the whole rate structure like a skyline. Short end, long end, credit spreads, mortgage rates, it's all connected. And but the Fed will just print crowd. Sure, the central bank can expand its balance sheet, but doing that while inflation is sensitive risks, reigniting the exact fire they just fought. That's why this cycle is tricky. The old playbook doesn't work the same when inflation is the villain instead of deflation. That's also why the chair's answer about struggling families matters. There's a social dimension. Inflation is not just an economic variable. It's political dynamite. When people feel the system is unfair, trust erodes. And when trust erodes, policy gets harder. So if you're wondering why they're cautious, it's because they're balancing more than just 2% inflation and 1% unemployment rate. They're balancing credibility, expectations, market stability, and real-world pain. And the end of the press conference, after all that, basically landed with, "No cuts today. Thanks for watching. See you next time." But we're not ending it there, because you and I are trying to understand what this means going forward. Here's my takeaway in one sentence. The Fed is not done, but they're not in a hurry. And the bond market may keep conditions tight even if the Fed eventually eases. So what do you do with that? You build resilience. You avoid being over-leveraged. You keep your emergency fund realistic. You invest with a longer horizon than the next meeting. And you stay ready to pivot, not because you're panicked, but because you're paying attention. And if you're successful, share your success story in the comments so others can stay motivated. I want this channel to be a place where people learn and also see proof that smart moves pay off. If you haven't subscribed yet, do it now, because this is exactly the kind of year where a calm voice and clear thinking is going to save you money and stress. All right, that's it for today. Keep your eyes on the data, keep your ego out of your decisions, and I'll see you in the next one. And just so we're clear, I'm here to educate and share how I think about money and markets. I'm not your financial advisor, I don't know your situation, and nothing in this video should be taken as personal financial advice. Do your own homework, think for yourself, and if you need specific guidance, talk to a qualified professional who can look at your numbers.